Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Great to have you here today. We got a lot of information to make you a smarter investor. We got 4 companies to go over to help you understand about investing. We're going to kick off the show with should you invest by following an insider's buy? I've heard people talk about this before, like, oh, that's a great thing. Well, we'll tell you about maybe it's not such a great thing. And we want to talk about it's not a stock market. It's a market of stocks. What do we mean by that? We'll explain that for you. Then also, too, on Friday, we had the inflation report. Comes in better than expected. We'll break that down for you and talk about that to see good, bad, or ugly. What's real numbers?
Yeah, always important to look at those numbers. And companies we're going to look at today include C.H. Robinson Worldwide. It is I'll call it a logistics company. Also, too, we're going to look at Cushman & Wakefield. We're also going to look at Qualcomm, a nice San Diego-based company. And lastly, PayPal. Excited to break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off valuation ratios, and also, importantly, those balance sheets that we want to look at.
Well, let's explain. When I said it's not a stock market, it's a market of stocks. Well, what do we mean by that? Well, I've often made this claim when things get crazy, like kind of there in the market right now. What I mean by this is you don't just have to buy the stock market. And instead, what you can do is look for good companies within the market. I always say it's kind of like when you go to the grocery store. You don't have to buy everything in the grocery store. You buy what's on sale. You buy what's fresh and so forth. The reason this is so important to understand is because individual stocks can still do well even when the broader market struggles, especially when the market gets heavily concentrated like it is today. And actually, it's been this way for probably a while here, and we keep talking about it. It's going to change.
It's been this way for several years. And, this isn't the first time it happened. Again, we often talk about the tech boom, but there's also the Nifty 50. I mean, there's been other times in history where we've had similar stories play out. And I'll tell you, the ending of the story most of the time is not good. Right. So, again, this is why we're pointing out this information for you to, again, make you a smarter investor. But as I talked about, we do often reference the tech boom and bust as an example investors should study. And in times like this, I believe it is even more applicable. From the tech stock peak on March 27, 2000 through the end of that year, the S&P 500 fell 13.4%. It is important to remember that the S&P 500 is a market cap weighted index, which means the larger the company, the more it makes up of the index. So again, those Mag 7 stocks are around a third of the market now. I mean, a very big concentration in those large tech companies. But if we instead look at the equal weighted S&P 500, where every company, I'm going to say essentially has the same weighting. I'm sure it's like, off by a little bit each week. But again, close. Essentially the same thing. It actually gained 10.7% from March 27th through the end of 2000. So, we're talking about, what is that, about a 23, 24% differential between your market cap weighted index and your equal weighted index.
Yep. And people don't realize, and we try to talk about this, about the different things. And looking at specific sectors during that period, utilities, healthcare, and consumer staples, well, they were actually up about 40 to 45%, and tech fell about 51.8%. So it's so important to, and I try to tell people this, oh, the market's going down. I think I should invest, or I need to close the account. It's like, no, market may be down, but we could be up because we don't buy the market. And this is a big mistake that people make. And they think, oh, but it's worked. And their time horizon, they think, is very long. But 5 years in investing is not that long. I mean, you should be investing for 20, 30, 40 years.
Yeah, and the thing I look at is I don't want to say, go out and buy the equal-weighted index, but I do believe the equal-weighted index will outperform the market cap-weighted index for the S&P going forward. I would, again, rather look for what we saw, like the healthcare, the utilities. Again, a 40% gain is better than a 10% gain like we saw at the equal-weighted. And I think you can, again, see a similar story play out where you're going to find good opportunities where even though tech is struggling, bringing down the index, it can still have other opportunities outside of tech, like we saw during the tech bust. And the thing that we always talk about, it's been just nice for many investors to enjoy the easy ride in the S&P 500 for the last decade plus. But I do continue to believe over the next 10 years, returns will be much more subdued in the index than investors have become accustomed to. And, you know, I'll be the first to tell you, the S&P, it has beaten us over the last 10 years. I'm confident over the next 10 years, though, we will beat the S&P 500 because the way this kind of works is you have the cyclicality. And when people come in for a presentation, we show them the cyclical nature between growth and value stocks. And they do have a cyclical relationship where value will outperform, then growth will outperform, then value. But really, since about 2008, growth stocks have outperformed. I mean, you're talking about an 18-year time period. It was the same thing we saw during the tech boom. It was a shorter time period of outperformance, but a huge spike in outperformance of growth over value. And then what happened? Reality set back in, and value had a huge outperformance. Are we in the middle of that pendulum swing once again? We know value's outperformed so far this year. I think we might finally be seeing that shift occur and actually last for once.
Yeah, and people, what they also do, when that happens, they're in the S&P 500, we'll call it, and it drops dramatically. Oh, all stocks are risky. They sell lower, and then they don't come back on the right time. And that's why we like value investing. It's a little bit smoother ride. I mean, we have talked about, you know, on growth companies, how growth companies will last 50 years, their worst 3-year return is, I think, a negative 55%. Value, the worst 3-year return in that time frame is about a negative 24%. So you may not like it, but you're not going to panic and sell. And that's why people just don't understand what they have. They're kind of sold on things from brokers, unfortunately. And then when real investing comes along, gee, you know, they may not be ready for it because they think, oh, everything's too risky. Like, no, value investing is different. You're buying things on sale. That's who likes to buy stuff at the high price? I don't get it.
The momentum investing has just never made sense to me. And it works for periods of time, but it doesn't work all the time.
That's right.
And when it doesn't work, that momentum can also hurt you on the downside. And the thing that I wanted to point out is, you know, I don't think the S&P 500 is going to be negative over the next 10 years. But the problem is people have become accustomed now, if you invest in the NASDAQ or the S&P, to, you know, 13, 14, maybe 15% annual returns over a decade. I don't believe over the next decade you're going to see that happen. You could only have returns of maybe 5% per year. And if you've adjusted your lifestyle to living that way, I mean, Harrison last week talked about trying to take income in a portfolio when it's declining on the S&P. It really destroys your returns. And I think a lot of people have set themselves up for failure because they've really overextended their expectations.
Yeah, and they just don't understand. That's why they got to listen to the Smart Investing Show every week and read the newsletter, do all these important things to make you a smarter investor. Well, they might say, you know what? Well, that's just too much work. Maybe I'll just invest following the insiders, what they buy. That sounds like a good idea because they know all the company. Well, it does. It sounds like an easy thing. Just do what the insiders do because they obviously know the company pretty well. If the stock were to drop in value and the insiders commit to purchasing shares, well, it must be a smart investment. Well, unfortunately, it's not that easy, and there are many other factors involved. Data also shows that longer term, it may not even matter. Over my 45 years of doing this, I have seen sometimes when they borrow money from the company will loan them money to do the share purchase, which is crazy because they have no risk in the game. And I've seen that happen. And just like, no, you want to make sure they're committing their own money, not getting money borrowed from the company.
Yeah, I mean, you kind of talk about when they are committing their own money, does the stock do well afterwards? That's the important point. That's what we want to know. Should we be following them? Well, Wall Street Journal did an analysis of 1,400 publicly disclosed insider purchases using S&P 500 companies. And going back to 2020, they discovered insiders at 327 companies had a total of $3.7 billion in stock trades over $100,000. Most of the purchases were completed after a decline from the previous 30 days and produced a median gain of about 2% a month later, but then began to decline after that.
And the numbers also show that only 15% of the purchases fully recovered from where they had fallen in the previous 30 days before the share purchase. It should also be noted that they cannot act on the insider information. That's so important because, oh, this is great, they know things. If they know something really important, they can't talk about it. They can't act on it. They'll go to jail if that happens. So if there's something major that they can move the stock either up or down, again, they're probably not going to do that. They won't do it because they risk the fact of if they get caught doing it, they're going to jail.
Yeah, not worth it. And
not worth it at all.
Again, in other words, since they can't act upon that insider information, they don't really have that much of an advantage over someone doing a good amount of research about the company. And, the other thing I point out is while they're going to know the business probably better, like I'll say the CEO of Microsoft, he knows the business better than I know Microsoft. There's no doubt about that.
I think you probably ran that statement.
But the issue that comes into play as well is valuation. He can't tell you how much somebody else is willing to pay for Microsoft.
Right.
Is it worth 30 times earnings? Is it worth 20 times earnings? Is it worth 15 times earnings? There's no real, I'm going to say, understanding from the CEOs of how much other people are going to be willing to pay for their stock.
And also to the emotional part of the market, because people do crazy things at crazy times, and you could have a great company. And we'll just pick on Microsoft, like, oh, yeah, but people don't care if there's something, all software is going to be dropped. Well, that's kind of in the news now. All software is dropping because of AI. AI is going to take away all software. So Microsoft's down. Some other companies, I think we did that last week. Did we talk about that last week, was it?
Either last week or 2 weeks ago.
Yeah, 2 weeks ago, where software companies are getting beat up because of AI. Well, that's an emotional thing. Even if you know the company very well, that's not going to stop people from selling. So you got to understand the business.
I know, like Salesforce, for example, has just been absolutely hammered. And Mark Benioff, the CEO, just keeps saying it's the best the business has ever been. It's the best the business. So there is that disconnect sometimes between business fundamentals, business growth, and valuations. And sometimes a company might be talking about, the business is great, but it's trading at 50 times earnings. The market might not be willing to pay 50 times earnings anymore. And the business could still be doing very well, but it gets a market adjustment down to 30 times earnings, and the stock falters.
Yeah, and that's one thing you brought up, stock trading at 50 times earnings. I mean, this is the craziness that happens, and this is when you get burnt, and that's why we tell people, you've got to understand what you're investing into, because that may be great for a while. And again, a while could be a year, 2, maybe 3 years.
It could be 10 years.
10 years. Lasts for a while. But eventually that will change, because everything comes back to the mean, and the average for trading amount for earnings for companies around 14 to 17 times historically. So if you got a company trading at 30 times earnings, there's one or two things going to happen. Either the earnings will rise dramatically to meet that, but then that causes it to go even higher, or the stock will fall to meet the mean there. And again, we're talking long-term investing, because when you do these things, you really just don't understand why you bought them. You don't know why you sold them until it's many times too late. So, you want to talk inflation?
Sure, let's move on.
Yeah. Inflation report comes in better than expected. The Consumer Price Index, also known as CPI, showed headline January inflation was just 2.4%. Quite the number. Now, this compares to an estimate of 2.5% in last month's reading of 2.7%. Core CPI, which backs out food and energy, came in line with expectations at 2.5%. But it was also lower than December's reading of 2.6%. And I love this number, and the smallest increase since March 2021, when it was just up 1.6%. That's a low number.
A low number, and this is before the whole inflation spike. This is even before transitory inflation. I mean, this is, again, about 5 years ago now.
That must be COVID. When did COVID was it?
COVID was 2020, but really that inflation onset from all that money that came in, inflation started to climb in April of 2021, and then it really climbed up to 8-9% on the headline.
And I think that was because the government gave all this free money for people, and there's just too much money chasing too few goods. So had they not done that, probably inflation would have not spiked to where it did.
Definitely not the way that it did. Yeah. Looking at food prices, though, they did put a little pressure on the headline number, as they were up 2.9% compared to last year. Most of this, though, came from food away from home, where prices were up 4%. And food at home, on the other hand, only saw prices climb 2.1%. And I bring this up because, again, this is indicative in my mind of a strong economy. We got the jobs numbers. We're not addressing that today, but it was a very good jobs report with 130,000 jobs created in the month of January. But food prices away from home, that's going to be your restaurants, your bars, things of that nature, they would not be able to raise prices and still garner the type of tourism to their respective businesses without a strong economy. So this, to me, is still bullish about how well the economy is doing.
You know, one thing that doesn't show that I learned in the past, I think we talked about recently, was a thing called shrinkage, where you go to the restaurant and you would get before maybe a 5-ounce piece of meat. Now you might get 4.5 amount, or you might get fewer potatoes or something. I mean, they're kind of shrinking the plate to not change the dollar amount you're paying, which doesn't show up on the food side. And I think that is happening going away from home. And away from home just obviously means eating at restaurants, And I think they combine all the restaurants, fast food, regular food, everything. Yeah. So
Away from home.
away from
Not
home.
in your house.
Not in your house. Does that mean if you go to McDonald's and pick up the take it home, then it's in
That's
home?
away from home.
Because you got it away from home. Exactly. Energy prices helped the headline number as prices declined. Love this, 0.1%. As gasoline prices fell 7.3%. I don't think that happened in California. I don't know. Offsetting this benefit was utility prices, where electricity was up 6.3%. And I don't know if this from the cold back east and the south, I guess they had, but utility gas service, well, that was up 9.8%. So that really took a big hit on the energy side.
Yeah, and we pointed out in the newsletter this week, again, got to get the newsletter if you don't, but we talked about electricity prices, that they're actually double about inflation right now. And I do have concerns that electricity prices are continuing to be a headwind as we move forward. I mean, the data centers, there's some real big problems there, and how that could impact consumers on an everyday basis. And this is one area of the inflation report that I want to keep an eye on, because I think electricity prices, you could still be seeing these big spikes for potentially years to come, depending how this AI build-out plays out. But many other areas, they did see muted price changes. Shelter, though, continued to add pressure to both the headline and core CPI numbers. Even though the annual rate of 3% was lower than December's level of 3.2%, it is still above both the headline and core numbers. As a reminder, this is a huge weight at around 35% of headline CPI and over 40% of core CPI. So essentially what I'm saying here is shelter's at 3%, headline's at 2.4. Anything that's above headline means that's pushing up the headline number. If shelter all of a sudden were to flip and go lower, that would benefit your overall inflation rate.
Just make a quick comment on the energy side as well, because we talk about, and again, you talked about getting the newsletter, because there's something on there about data centers and the big demand for electricity. They're pushing out the price of all electricity. We talked about, for them, they need to come up with a separate way of billing them, because it's not fair that the consumer has to pay all this higher prices because the data centers that are just taking all this electricity. It is going to be a problem down the road, and I think right now consumers are going to pay for it. So hopefully something will come out. I know, like on my personal water bill, the more I use, the more I pay.
Yeah.
So maybe they need to do something like that, like a tiered amount for businesses. And again, we're pro-business, but the data centers just absorb so much electricity, so much power.
Yeah, I mean, it's scary.
Yeah. Well, back on the shelter, if all else remains the same and shelter declines this year, I believe we could see that 2% target achieved. I was surprised to learn that the owner's equivalent rent, which is OER, which essentially measures the rate homeowners believe they could rent their house out for, carries most of the weight at over, this is crazy, 70% of that shelter category. In January, the OER was up 3.3%, while the actual rent of primary residence category was only up 2.8%. That what people think they can, people are always way over. Oh, my house is worth $1.2 million. Oh, I could rent my house out for this. They're way overpriced. I don't know who in the government came up saying this is a good thing. Let's see what people think their house is worth renting at. They're always going to be high.
And most people don't even know. They're like, oh, my house is worth $1 million. They then can't comprehend how to adjust that into a cash flow measure of what they could rent it out for. Now, some people, they have rentals, so they'd have a better idea. But your everyday person, they don't have any idea. I'll be honest with you. I have no clue what I could rent my house out for. I haven't looked at the market for rent. So why, if somebody calls me to ask, how much can you rent your house out for? I think $5,000 a month. Oh, okay, that sounds great. We'll pencil that in. What? That makes no sense.
Yeah, I mean, the consumer, the homeowner, 80% of them, I think, have no real clue what their home is really worth rental-wise. That's why it's such a crazy number. And it counts for, what, almost 70%?
70%.
Over 70%, I think it was.
And I think of the entire CPI, I think that part is almost 30%. I think it's like 27% of the entire index is the owner's equivalent rent.
I think we need to go to D.C. and kind of set them straight. It's like, this is a crazy CPI number. Because I think if it wasn't for that, we'd probably be the target amount. Because, yeah, food was up somewhat, actually energy was down, some things are up. But to count this much, it just makes no sense. And I don't know when this changed, but it's just...
I think it was like in the 80s.
Was it in the 80s?
I want to say, because I think before they had the median home price,
Right.
but that was so variable. So they tried to smooth it out. But now I think they've distorted the number. And, if you look at median home prices, I mean, those are only up, I think, like 1-ish% now year over year. We're not really seeing big home price appreciation. And also, too, we talked about the national median rent for apartments. They actually fell 1.4% in the month of January. And they're now actually 6.2% below the peak in summer of 2022. So we've seen a decline here in actual apartment rents, but we're still getting 3% inflation numbers on the shelter index. There's just a big disconnect in my mind. And I think there is a lot of credence now to some Fed officials saying, well, I think inflation isn't really the big concern any longer.
Right. And people say, oh, things are up. And yeah, things are up. But again, inflation numbers, I think they're overstating things, which is not a good thing. And all this information does come from our website, as we said, smartinvesting2000.com. We have other topics in there. Do unions help or hurt the economy? More relief coming from or for inflation? Can the U.S. and Chinese economies grow without each other? Retail sales show the consumer may be slowing. The jobs report, we talked about that in the newsletter, was worth the wait. And then everyday consumers could be impacted by large data centers, that one that we were talking about there. It's all free at our website. It goes out every Friday at 4 o'clock to your email. Go to their website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You want to talk about a company?
Let's do it.
I don't want to.
Okay. We'll end the show then.
Yeah, show's over. All right, obviously just kidding. Well, let's take a look at, there's been a lot in the news about AI and taking over businesses and corporations and buildings. And, there's been last week there was a lot of pullbacks. We decided to look at C.H. Robinson Worldwide. Oh, what does this company do? I think I got my things mixed up.
You have C.H. Robinson?
Yeah, what?
That's the one we're looking at.
That is the one, and they do. They're
logistics.
Logistics, that's what it was. Because I know there's another one we're going to talk about this. So they're in the integrated freight and logistics. They did get hit as well as the real estate, corporate real estate companies as well. Wow, the short float on this, I don't know if it just happened. It's 8.4%, so that's kind of high. Now, they do have a high PE, so maybe this was warranted that they pulled back. PE starts at 36.5. The industry's at 21. Price to sales, 1.1 versus 0.9. Price to book value is high, 11.3 versus 3. We do see price to cash flow, very expensive as well, 23.4 versus 9.5. They have a decent PEG ratio, which is your price earnings divided by growth, tells you how much you're paying for the future growth. It's only 2 versus 5.8. Now, the earnings were up 28% of last year. The industry was down 3.1. Sales were down 6.9%, but the industry was up 1%. 5-year growth on the earnings per share growth estimate, 14.6% versus 9.4%, so that's a positive. They pay a decent dividend, 1.4%, using about 50% of their earnings to pay that out. Let's take a quick look at the balance sheet here, see what that looks like. Current ratio looks good, 1.6 versus 1.2, and debt to equity, 0.8 versus 1. We do see a net profit margin of 3.6. That's slightly under the industry at 4.3. And return on equity, very good, 32.3 versus 18.2. And cash flow, they only have about $800 million in cash flow. I say only because the industry has about $3.3 billion in cash flow. Chase, what do you got going forward?
Yeah, and my belief is I don't think they have a lot of the actual physical trucks. I think they're more of an asset light model, if I'm not mistaken. They're more of a service.
A service, yeah, because I was thinking that too.
Intangible.
It's not the J.B. Hunt and the other big ones you see. They actually provide the service to them for logistics.
And I think that was the concern there was, again, this AI wrecked the market everywhere. It seemed like people were just selling, and it doesn't matter, AI, we got to sell everything. And I guess the concern was there's AI-powered logistics software that could eat away at this company's business. There's a couple banks that came out. We got Barclays, and I think J.P. Morgan was the other one. They came out with notes saying they think actually C.H. Robinson will be benefactors from AI, as they've already been working on internal AI to improve their businesses. But looking at the current price, I'm a little bit concerned on the valuation. I'll tell you why. Current price here, $176.01, 52-week range. I mean, the stock's done well, up. Low is $84.68 and the high $203.34. I mean, the 1-year return 78%. The 5-year return, you're up about 100%, we'll call it, not inclusive of any dividend. And the 10-year return, it's done pretty well, up about 150%. But this is where the concern lies. Even with this big pullback we saw this week, you got to December 2027, estimated earnings per share of $7.16, gives us a target sell price of $118.86. I mean, the future earnings of this company are still valued at a forward PE around 23, 24 times.
Yeah, and this, it just sounds like this company got ahead of itself, and maybe it's good to pull back because it was way too pricey. And when I look at those earnings, I see that the range is pretty wide as well. You got the 26 analysts, the low 540, the high $8, so that's not good. We look at target range there. But yeah, I was hoping to find something good here because of the getting hit like that the stock would be on sale, but it's not.
I mean, this whole AI thing is reminding me of Amazon a few years ago, where I remember Amazon, they're getting into auto parts.
Yeah, malls are going to be gone. Yeah.
Well, but Amazon would get into pharmacy. They get into auto parts. And that particular sector would just sell off on the news. It seems like the same thing is now happening with AI. So I think there are going to be opportunities where people get overly concerned about something. As you kind of brought up already, we're going to talk a little bit about the office space. That might be a sector that was oversold this past week on just news that won't come to fruition. I think there's a high likelihood that C.H. Robinson is fine with the AI changes, but I'm not willing to take a risk if AI eats into their business and they're trading at 24 times future earnings.
Yeah, you got to get the business on sale. You can't, because again, we don't believe AI is going to take away everything. I mean, we talk about that. Gee, if AI does that, is Elon Musk going to be the only one that's a billionaire? Well, no, because then nobody can buy the stock because they don't have a job to do that. So things, and we've talked in the past too about how there's jobs that will replace it. I think we did that a couple of weeks ago, some jobs that aren't even thought of yet that will come out. But things are changing. If you're sitting there doing nothing, you will be left behind. You have to understand what is happening. You can't do the same job that maybe you did 5 years ago. You have to be evolving with the technology.
Yeah, and I hate to say it, but there's a lot of jobs right now that, aren't necessarily going to be lost because of AI. There's been a lot of studies that there was a lot of overhiring done in the kind of post-pandemic correction, I'll call it. And now people are kind of using AI almost as an excuse to let people go and say, well, AI, and it's making them sound good.
Right.
But in reality, it's like, we don't really need them anymore. It's not the AI, it's just they overhired in many cases.
Yeah, and that's what they did. They overhired, and now they got an excuse to reduce them. And it's just kind of, because back then, if you remember, people were so worried, like, oh my gosh, we can't get anybody to work for us. We better overhire and have those people when we need them. Well, now they found a way to get rid of those people. So, all right, we'll take a quick break. When we come back, our financial planner, Harrison Johnson, is coming on. You're going to love this one. You may be getting a larger tax refund. Gee, that sounds pretty good. Probably won't be me, though, but other people probably will. All right, stay with us. We'll be right back after this quick break. All righty, welcome back to the second half of the Smart Investing Show. Yeah, this is the time of the show when we talk about financial planning. We talk about taxes. We talk about building your retirement for good ways. Financial plan is so important. I mean, I've seen people, how do they do it without a financial plan? I often wonder. But today we're talking about taxes. So, and this is a big one. You may be getting a larger tax refund than you expect. And this is great. What's going on here?
Well, the tax law passed last July, but a lot of the provisions in it were active for tax year 2025. So now people are filing their taxes, and some of them might be getting a larger refund that they were used to getting, or something more. So some of those provisions that were in the law, you don't have to do anything. You don't have to file a certain way or claim a certain way. It's just kind of built into when you file. So like the standard deduction, for example, that increased for everybody, and then if you're 65 or older, it might be even a little bit higher. But that's just kind of standard. You don't have to check. Can you guys hear me? Oh, here we go.
Oh, yeah.
You don't have to check a box or do anything. That's automatic. Something else, the salt cap increasing from 10,000 to 40,000. You'll put in your property taxes, car registration, state income taxes. Usually tax softwares automatically grab that. But that's not something that you have to do. It's automatically going to know to apply that higher cap. Another one is the child tax credit. So that increased a little bit. So that'll automatically apply if you put in your dependent information. So those things are might result in a larger refund. There's other things though that you might have to make sure that your return is filed correctly. So the tips, if you receive tips and some of them are not going to be taxable, that you need to make sure that that's being reported correctly on your taxes. Same with overtime. With the W-2s that are being received, some of them might have that income broken out, but it's not a requirement that payroll had to have those broken out. Next year it will be, but this year it's not. So you want to make sure that if you earn overtime, if you earn tips, do you qualify for those deductions, not including that in your income, but also you have to make sure that you're filing that correctly. Another one is the auto loan interest. You're not getting a 1098 necessarily like you would with a mortgage. You might just have to go to an auto loan statement, see if you qualify for that, and then make sure that's included. So all of those things might result in a larger refund. Some are automatic, but some you might need to make sure it's reported correctly.
And one thing I noticed on this really seems to benefit the middle class, because you always hear, oh, the tax cuts are for the rich and all the rich could benefit. Well, no, there's a thing called, is it magic?
Maggie.
Maggie. Yeah, I was going to say it's magic, but it's not magic.
Not magic.
It's not magic at all. Maggie, which really shows that this is for the middle class Americans. That's going to benefit them the most.
Most of the things that I mentioned do have adjusted gross income limits or modified adjusted gross income limits. That's what Maggie stands for. So the extra $6,000 deduction for people over 65, that has an adjusted gross income limit that starts to get phased out at $150 for married couples. The SALT cap increased up to $40, but that starts to get phased out when income exceeds $500,000. That's still pretty high. The child tax credit, that starts to get phased out as modified adjusted gross income exceeds $400,000 for married couples. The auto loan interest, I think that one's $200,000. The overtime and tips, they have income limits as well. So all of those things do have income limits. So yeah, people that are in that 10, 12, 22, even 24% tax bracket, that kind of applies to those people. So depending on how many of these things that you qualify for, you could get a refund of a few $100s to a few $1,000s more than what you're expecting.
The other thing I want to point out with this is, a lot of times people gauge changes to the tax code based off of their refund. And that's the totally wrong way to do it. It's like, oh, this didn't benefit me. I had a $3,000 refund last year. Now my refund is, $3,200. So it wasn't even that big of a deal. But you have to understand that the refund is just an equation of how much taxes you owed versus how much was withheld throughout the year. And you could have had something happen last year where maybe you had capital gains, dividends that were higher than the previous year. So the way to actually gauge if this is benefiting you or not benefiting you is your total taxes paid, not the refund or lack of refund, I'll say.
Yeah, exactly. So and you can find that looking on your tax return. Federal and state, it's going to be like on the second page. You'll find adjusted gross income somewhere, a deduction, and then you'll find taxable income. And then after that, it's going to say tax liability. And that's the actual amount of tax that you paid. And ultimately, your refund, like you said, Chase, is based on how much you had withheld throughout the year. But that tax liability, did that increase or decrease? Also, how did your income change? But the next thing I was going to say is if you did receive a larger refund, it may be worth adjusting your withholdings through payroll, starting right now, so that your paycheck gets larger for this year, so that you're not waiting for next year's large refund. You can kind of get that benefit sooner by adjusting your payroll and having a larger take-home pay.
And there was no sunset provision on this. I mean, I didn't hear any time it's good for this year and next year.
Some of them do. Some of them
limits
do.
on them?
Some of the provisions here are active for 2025. So what we're filing right now, tax year 26, 27, and 28. So some of them have 4 years. And then, within that time, we'll see. For example, right now, one of the things that did not change that was supposed to change were the tax rates themselves. So the tax rates since tax year 2018 have been 10, 12, 22, 24, 32, 35, 37. Starting this year, they were supposed to sunset or increase back to what they were, 10, 15, 25, 28, 33, 35, 39.6. But that did not happen. So that was something that was supposed to sunset, but it never did. So these provisions, maybe something similar like that will happen where it's only supposed to be for 4 years, but when we get there, depending on the administration and Congress or whatever, those could be extended.
I think
also.
some of them is like the auto loan thing. I think is temporary. It could sunset. I think the Social Security or the extended deduction for seniors, I think, is temporary. I think there's
Most of these things, I think, are temporary.
Yeah. But I think the tax rates, as you said, were now
The
signed into
tax
law.
rates themselves now are
Permanent.
permanent. I mean, nothing's permanent, but they're not at this point expected to change until action is taken to change them.
And I just want to say one more thing about your refund. My personal goal is to get a small refund each and every year. I don't like to obviously have to pay come tax time, because also that could mean maybe I under withheld and then there's penalties and interest. Definitely don't want that. But the larger the tax refund, all that means is you give the government a 0% loan for the amount of time that they held your money. So don't think a good refund is a good thing.
Yeah, I want to owe money.
I don't like that surprise.
Not too
but
much
like,
with
yeah.
a penalty, though. You don't
Well,
want
I mean, I've got a pretty good handle on it, so
I want to be somewhere within owing 100 to getting 100. That's kind of the end goal.
and we talk about this because a lot of people, they don't use a tax person or CPA. If you don't know this, you're going to miss some deductions. You're going to miss out on things. You got to know
I mean,
something.
yeah. So again, with the tips, with the overtime, with the auto interest stuff, if you had tips or you had overtime, you paid on auto interest, that doesn't necessarily mean you qualify in the first place. But if you do qualify, you want to make sure you're getting that full benefit. So, working with a tax person or just being on top of it yourself, or, working with somebody like me to make sure that you're getting all the information that you need and it's also being reported correctly.
Exactly. Well, Harrison, thank you very much. Again, Harrison Johnson is our CFP, our financial planner here at Wilsey Asset Management. If you want a free consultation with him, go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com, or give a call to the office, 858-224-0004. Again, that's 858-224-0004. Thank you, Harrison.
Thanks, guys.
Alrighty. All right, let's move on to what company we're going to talk about now. Now we're going to talk about Cushman Wakefield, which is more dealing with commercial properties and the like.
Yeah, commercial properties, and this is kind of pinging off that AI theme that we were talking about earlier, and they got hit pretty hard this week, along with a lot of other commercial property plays. But there was two things that kind of hit the commercial properties, and I find this interesting. But it says investors worry that AI could sound a death knell for the sector following the difficulties from COVID. And there is, I guess, a gentleman named Matt Schumer. He's a Other Side AI co-founder and CEO. He said he believes the impact from AI will be bigger than COVID, and entry-level white-collar jobs will be gutted thanks to AI. And the essay garnered 30 million views in 24 hours. And then before his essay, Elon Musk was on a podcast, and I love this. Corporations that are purely AI and robotics will vastly outperform any corporations that have people in the loop. Computers used to be a job that humans had. You would go and get a job as a computer where you would do calculations. They'd have entire skyscrapers full of humans, 20 to 30 floors of humans just doing calculations. Now, that entire skyscraper of humans doing calculations can be replaced by a laptop with a spreadsheet. So Musk believes that these skyscrapers will be empty.
Right.
So basically that means nobody's going to have jobs. I think we're just all screwed as a society. So better sell everything.
And Musk, again, very intelligent guy, but he's always way, way far ahead of the curve. I mean,
We were supposed to have self-driving cars in 2019.
Yes, and now it's 2026, and they're still
Not just self-driving cars. We were supposed to have like full-fledged self-driving.
Yes.
You
get in the car, just take you around. Yeah. So there's other things he's been kind of a little bit too optimistic on, and I think the same thing here. And things will change with time. And
I truly believe if this were to happen, I mean, if you were to wipe out all of white-collar jobs,
right,
or his robots. I mean, if his robots then could do machine work, they could do plumbing, they could do pretty much any job. I mean, we as a society are over. I don't even care how much you invested, because we'd have to be on what's known as UBI, or universal basic income, and society would cease to exist. It doesn't even matter how much money you had, because pretty much everything would be worthless at that point.
Yeah, it would change society.
I mean, it's a scary, scary thought.
Scary thought, isn't it?
But you just got to keep ignoring it, because it's like, well, if it does come to that point, it doesn't matter what you do.
And again, we keep saying evolution is always very scary. It was scary for the Industrial Revolution. It was scary back in the 90s. And it's just always scary because change is unknown. So it scares you. So,
Yeah.
but I do believe we'll get through it. But things will change. So, but let's talk about Cushman and Wakefield. Their symbol is CWK because they got hurt quite a bit the other day because of all this. They're in the real estate service industry. About 3.9% shares float, 93% institutional owned. We do see a good start here. PE ratio is 13.6. That is well below the industry at 28.5. Price of sales 0.3 versus 2.1. Price to book value 1.5, just slightly above the industry at 1.3. We do see price of cash flow 15.3 versus 14.9, a very good PEG ratio. Cushman Wakefield, it's at 0.8, but the industry is 34.9, so not paying much for the future growth of Cushman Wakefield at this point in time. Wow, their earnings up 69.6% above the industry at 52. Sales climbed by 5.9% versus 5.4. They have a 5-year earnings per share growth estimate of 12.9. That's very good. The industry's at 3.7. So Cushman and Wakefield looking pretty good here so far. Let's take a look at the balance sheet. Current ratio is 1.1 versus 1.3. Debt to equity on the high side, though, 1.6 versus 1. We do see a net profit margin at 2.2. That's very low compared to the industry at 8.9. So I want to know why that is so low. Return on equity 11.4 versus 6. Cash flow for Cushman is 165 million. The industry is at 553 million, so that could be a little bit better. Don't like seeing that. So Chase, what do you got going forward?
Yeah, I mean, this is a interesting real estate company in my mind, and we actually technically use them. I know the gentleman that helps us on our tenant representation is with Cushman and Wakefield, and the building that we're in here in San Diego, I don't think it's any longer, but I think they used to be a property management through Cushman and Wakefield. I mean, they have also, the transaction side, so they'll kind of do consulting, appraisals, and then the real estate purchase and sales transactions. So, I mean, they're pretty obviously heavily into the commercial real estate space, whether it's buying, selling, renting, property management. So, I mean, it's definitely going to hinge off of commercial real estate activity.
Right.
If people are coming and they're having good leasing and they're having a lot of activity in the office space, that's where you want to be as Cushman and Wakefield. But looking at the numbers for the company, again, their ticker symbol is CWK. $12.89 is the current price. 52-week range, the low here, $7.64. The high, $17.40. I see year-to-date, the stock is down about 21%. In the last 5 days alone, the stock is down 21%. So they got hit very hard over these concerns with AI just totally displacing the office space.
You going to give the 5-year return as well?
The 5-year return, for some reason, my system's not showing that. So if you have it, I'll take it.
Negative 19.1%. So if you've invested with a company for 5 years, you made no money. You probably overpaid for it. I would have loved to got this company when it was at $7 and change. That would have been a great buy. But I guess we'll see more if it's a good buy now at 12.
I mean, speaking of that point, I mean, the valuations look very attractive, and I'm not surprised by that because the office space has been so discounted and so unloved for several years now. But here's the number, $1.45 is the estimate for earnings per share in December 2026. That gives you a target sell price of $24.07. I mean, the forward PE on this company is about 8.5 times. I like what I see here. The only thing that disappoints me is I wish they paid a dividend.
Yeah, I would think they would. I was surprised myself that why they don't pay a dividend. I don't understand why, but they don't. So, not a good thing.
It's their balance sheet that looked okay. Their debt to equity. I was kind of looking at some other things while you pulled that up.
No, I mean it all looked pretty good. I mean I didn't see much wrong with it. The debt was a little bit high. I mean the debt was at 1.6. Sorry about that. Yeah. So,
But I think they're asset light. They're not like a REIT where they're going to own the office space. It's more of a consulting type situation, which I don't think that necessarily gives you a pass on the balance sheet, but it gives you a little bit more to look into and make you question. Well, maybe the 1.6 is okay. But you have to understand what's going on there. But I'd say overall, I think there's definitely some intrigue here.
Yeah, I think so as well. And actually, we will point out that last week, because we do have a real estate investment trust in our portfolio that actually is in commercial property, we will point out that we did take some time and added to that position because we thought this is a short-term thing. And it's just things are changing. And when we listen to what they talk about, and this is our read, rents are up, prices, leasing is up. I mean, people more interest. I mean, it's not, people come back to the office. I mean, all these positive things we're hearing. So this is why people get emotionally scared, because a couple little articles like, oh, and that could be 10, 15, 20 years down the road. So be careful what you're listening to there. Should we do another company?
Yep.
Let's go back to San Diego and talk about Qualcomm. Qualcomm is in the semiconductor industry. About 3.6% shares float here. 82% institutional owned. P ratio 28.4. That is below the industry at 49.1. Price to sales 3.4 versus 13.9. That's a big positive. Same thing with book value, 6.5 versus 11.2. Price to cash flow 10.7. Also great compared to the industry at 37. And a very good PEG ratio, 1 versus 11.7. So the valuation ratios for Qualcomm looking pretty good. Unfortunately, their earnings are down. I don't know why, but their earnings showed down 46.5% over the last year, when the industry is up 49.9%. But its sales of Qualcomm were up 10.2, which is good, but not as good as the industry, up 34.6. 5-year growth rate on the earnings for Qualcomm is 12.7 versus 30.6%. Qualcomm does pay a dividend. They pay about a 2.5% dividend. They use 70% of their earnings to pay that out. Balance sheet, let's see here. Current ratio, a lot of liquidity, 2.5. Still good, but below the industry at 3.4. Debt to equity, 0.6 versus 0.3. We do see a net profit margin at 12%, not as good as the industry, which is at 28.5. And return to equity for Qualcomm, 23.3 versus 56.9. Free cash flow is $12.9 billion for Qualcomm. The industry, $43 billion. So, I mean, Qualcomm looks pretty good, but gosh, compared to the industry, it's not looking that good. I'm kind of disappointed here.
On free cash flow or other measures?
Oh, all the measures.
Yeah.
I mean, it's like, the growth rate. Yeah, growth rate was what I say, 15%. I think I said, 12.7. Well, that's a good growth rate, but the industry at 30.6. So
yeah, I mean, it's not. I know it's trying to get into AI, but it's not as heavily into AI. Right. So I think you are comparing more against your Nvidias, your AMDs that are playing in that space. But then you look at the valuation ratios for other chip companies, and that's where there's that. I think that balance, so to speak. But looking at the current price for Qualcomm, again, their ticker symbol QCOM, $140.70, 52-week range. The low here, $120.80, and the high, $205.95. Year to date, the stock has really been hit quite hard, down about 17%. Over the last year, down 19%. 5-year return, wow, not very good here, down 4% over that time period. 10-year return, though, you're up 184%. So, your return pretty much all, again, came in the first 5 years rather than the last 5 years. Yeah. Going forward, though, this is where things, I'm going to say, are somewhat interesting. You can go out to September 2017, estimated earnings per share, $11.31, gives you a target sell price of $187.75. That's an estimated return about 33%. So, I mean, this would actually be rated a buy based off the valuation at our firm.
I'm kind of looking at the numbers. 2026, it was $11.15. Only goes to $11.31 a year later. Now, we have talked in the past about them losing that $2.5 billion contract from Apple in 2027. That could be part of it. But then we have said, too, maybe with, what was the revenue? $44 billion, a $2.5 billion lost revenue is not that big of a deal for them. I mean, it's not great. You never want to lose that kind of revenue. But I'm just disappointed on the growth on the earnings.
A big thing that Morgan Stanley, actually, they downgraded Qualcomm this last week over concerns over memory shortage in Micron and the other areas that have really seen prices spike.
Right.
And I think what's starting to concern people here is obviously now you have your data centers competing for these memory chips as well, and it doesn't necessarily impact what Qualcomm has to pay. But I think the concern is it's going to cost phone makers more to buy these memory chips, and then that's going to hurt in demand for smartphones, which is really where Qualcomm makes their money. It's not just Apple, but Android, and I know they do have, I think Xiaomi is one of their larger customers as well. So if you have this slowdown in smartphones, that's also going to hit Qualcomm. And they did have kind of guidance that didn't live up to analyst expectations when they reported. That's why the stock did get hit when they reported last week.
And I think the stock's been as high as $218 a share just about a year and a half ago. I mean, it was pretty high.
I gave that high was 205.
205 was a high. So, yeah, and people are like, oh, this is great for Qualcomm, but again, I think now could be going on sale. I think it's bouncing around the 135 to 140 level.
Well, the thing that I find funny, right, is that Apple, everybody got all excited about Apple again this year, but then they're worried about Qualcomm smartphone sales because of memory, but then memory is not going to impact Apple, and somebody's wrong there.
Yeah,
One
you
of
both
those
can't
is
be
re-
right.
yeah.
That's true.
So I mean, we'll see. But I know the interesting thing with Qualcomm is they are trying to diversify, but the problem is they are still so heavily in the smartphone business that is, or they call it the handset business, that they really need to ramp up their other revenue streams to counteract any potential losses in handset.
Well, let's move on to a company that's pretty well known, but and actually their product's pretty well known. I'm talking about PayPal, and PayPal owns Venmo, which is Venmo. It's becoming like also like a name, which is like, yeah, Venmo me the money. I mean, it's kind of like make me a Xerox
Like a
copy.
Google.
Like a Google, yeah, exactly. Google that, yeah. So, but they've had difficulties over the years, and they've got that great Venmo name. They may be having trouble monetizing it. They're in the credit service industry. Short is about 4.7%, 83% institutional owned. Wow, PE ratio 7.5 versus 24.5. Price of sales 1.2 versus 4.6. Price of book value, also similar story here, 1.8 versus 4.5. And then price of cash flow, very good, 6.1 versus versus 14.1. PEG ratio is 1.3 versus 4.5. So valuation ratio of PayPal look pretty darn good here. Now, this is surprising to me. Their earnings over last year were up 35.6%, well above the industry at 6%. We do see sales climb by 4.3%, not as good as the industry, up 14.4%. And the 5-year growth rate for PayPal, 5.5%, which sounds okay, but the industry is at 13.7%. Now, they do pay a dividend. Surprises me on that, but their dividend is about 1.4%. This is strange. The payout ratio is only 2.6%, so they seem to have a lot of money coming in to pay that 1.4% dividend. Taking a look at the balance sheet, we do see we have a current ratio of 1.3 versus 1.7. That's good. Debt to equity, also good, 0.5 versus 1.4. Net profit margin checks in at 15.8 versus 19.3. Both of those are very good. Obviously, 19.8 is better for the industry than the PayPal. Return on equity, 25.8. Cash flow, $5.5 billion. Again, that's a lot of money. But the industry shows cash flow at $16.9 billion. So I think PayPal has some potential perhaps. But on the other hand, too, it just seems like it doesn't have enough to keep the stock going. I mean, I don't think the stock price is just terrible with the stock price has done, especially over the years.
Yeah, I mean, current price here for PayPal, it's $40.29. The 52-week range, the low here, $38.46, and the high, $79.50. Year-to-date, the stock has just been crushed, down 31%. Over the last 1 year, down 47%. Over the last 5 years, you're down 87%. 10-year return, you have made money up about 12.6%. It had a huge spike in the first 5 years, and it's just obviously given that all back. The all-time high for PayPal back in 2021 was $310 a share.
I don't think it's ever seen that price since then, has it? Never.
No. It's at 40.
I mean, sometimes it go down and back up, but I think it was just down continuously from that time frame to the, what did you say the price was now, 40?
40.
Yeah.
Yeah. And I mean, you go forward for PayPal, you go out to December 2027. I mean, the valuation ratios are great. I mean, estimated earnings per share here, $5.82. You get a target sell price of $96.61. It's trading under 7 times earnings currently.
And I do see that those earnings have come down. They were at $6.63 about 90 days ago, down about almost 10% to $5.82. So that could be the problem, is that where is the bottom for this company? How much can they make? I like the valuation ratios on it. It's kind of tempting, but I do worry the main thing seems to be Venmo.
Well, and I mean, we held this company. I can't tell you where we bought it, where we sold it. It was a good investment for us. Obviously, we don't hold it today at $40 a share. They did have a CEO change. Alex Chris became CEO. We liked that, but he has actually been replaced. And I worry he's more of a scapegoat in a changing time period. I don't think they really gave him a fair shot. It was just something I think the stock showed, so it's just wrong place, wrong time for
So
the guy.
they replaced him because I thought he'd be a good benefit to him. He had a lot of connections with business, but he's gone.
I just think, I mean, personally, I had used the PayPal wallet a little bit more when we held PayPal to learn about it, but since we sold it, I don't use it. It was just, it's not as easy. The Apple Pay, as much as I knock Apple, it's so much easier, and I just worry that, PayPal is not going to be as big of a benefactor in this trend.
There could be something there, but
I think there's some risks to it.
yeah, too much risk for it. There's the closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Don't forget to sign up for the newsletter there. A lot more great educational information there for you on investing. Thanks for listening. We'll be back next week right here on the Smart Investing Show with Brent and Chase.